So very warm welcome to everybody for this is a FinTech tutorial. In fact, it is the last one in the tutorial cycle, and I made that quite clear to people who normally go to tutorial 2 as well. And what I'd like to talk about tonight, let me just start this. I think we are recording, yes, yeah. I will not be taking attendance tonight. Okay. The reason being, okay, if you look at the calendar, and I think I did actually mention this last week, so we are here, and next Tuesday will be the last lecture session, which is going to be actually a combination of a short exam plus your presentations, okay? And I normally hold the other tutorial on a Tuesday afternoon shortly before the lecture, which means it would have to be 20th of November, which will be like 2 hours before they take the exam, and I just don't see the point of doing that. So I actually invited them, if they wanted to come tonight, they can come. If not, they can just watch this recording, okay? So it is being recorded, and I won't take attendance either, because maybe they can't come on Tuesday, so it's not fair for them. But anyway, so welcome everyone. And what I want to do tonight actually is to talk a little bit about, give you an exam briefing on just guidance on how you can prepare yourself. I'd like to actually continue to discuss that venture capital example that we covered last week, and then to finish off, I think I'd like to have a look at a couple of articles on tokenization, okay, and then we'll just take it from there. Now, as far as the course is concerned, so actually this part is still outstanding, and this part is outstanding. So there are actually 55% still up in the air. So quite a bit to do in the final week. Okay. For the next tutorial, so I did say that I'm going to record this one, which is what I am doing now. Only Xin-Ming's part is examinable. We will be in the same venue that we were in for the first exam. You remember that place? Lee Kun Chun, LT1, and we're going to start at 6:30. We really have to be on time. The exam is an hour and a quarter, which takes us to 7:45, and people are never completely on time, but we have 6 presentations to go through in 2 hours. I think we might just make it, okay? For your projects, you can either send them to me earlier, okay, if you've already done it, or you can just bring it. But make sure we have a copy, please. Okay, I think I created a file in Blackboard already. So this is the calendar, and for the exam, it's going to be short questions, not multiple choice. Okay. And I don't know why some people thought it would be. It's not. So you should bring pens, and I don't think you need pencils. You can bring them, but certainly a calculator. Okay. And then now, what are the key topics? So the key topics are basically the topics that Xin-Ming has been covering. Okay, so you know what they are. So blockchain, although I think he takes a different angle from Bobby, both the style of his lecture slides and also the style of the questions that you're going to be asked. So we are testing, it says here, your understanding on concepts, your ability to communicate your views based on these, and then to apply them whenever relevant. Okay, I'll advise you that, sorry about the typo here. Knowing the what is likely not to be enough. Okay, there are some sort of open-ended questions where we ask you the why and the how. Okay, please don't expect we're just going to ask you what is a blockchain. Okay, I hope you can answer that. Right? But we will likely ask you, why is the technology, such a revolutionary breakthrough, and how do you think it can be applied? As an example, I don't know if there's a question like that, okay? But that is a style of kind of question that he can ask you. What are the strengths and weaknesses of AI? And one thing I would say to you, though, all right, is that don't kind of feel that you have to just restrict yourself to what you see in the lecture slides. There's only like 40, 50 slides per lecture, and a lot of them are diagrams. You should shake off that idea generally anyway. This is a master level course. This is not primary or secondary school. What that means is if Xin-Ming asks you an open-ended question, okay, and you read something somewhere in the MIT Review or Forbes, something that maybe we didn't even talk about, but something which is true, and you write that down in the exam, okay, and it happens to be true, and it's relevant, okay, even if maybe we didn't teach it, okay, I'll give you some credit for that. I will. You know what I'm saying? Yeah? Especially with a topic like this, which is so new and so hard to define, and where there are no textbooks, I think it's only fair that, if you read around, including some of the assigned readings that we have given you, if you read around, then we should reward you for it. Okay, either it's the reading in the reference material or anything else you might have dug up. Okay, so for all these topics, think about the why and the how as well. Okay, and you can even think a bit beyond, just whatever is mentioned in the slides. Okay. Now I want to actually go back a bit to just recap on. So last week, where we ended up was we were discussing. This was last week, okay, and we started talking about venture capital and how you can discount a stream of cash flows. Do you remember that? Yeah. And I think I showed you a spreadsheet which looks something like this. I'm going to put that up to Blackboard just to help you. Okay. This was what this is where we were. Okay, these are my notes. By the way, the exam is closed book. You know that, right? Is everyone okay with this? Yeah, sure. So you know how if there's a series of cash flows and then it reaches a certain point, sometimes called the steady state, sometimes called a stepping stone, curiously enough, or the S words. Stepping stone is the point at which you are reading kind of cash flow stability, and you just got to be careful how you discount them back and from which point of view you discount to as your terminal value, and then you discount from here back to here. Okay, remember we talked about that last time? Yeah, so I'm not going to repeat that. What I do want to do this time is take it up from where we left off, which was if you have a venture capitalist company, and this is referring to lecture number 8 with Xin Ming from page 19 onwards. Okay, I'll just show you the page. Whoops. Okay. Okay. So what's happening is, okay, imagine a situation like this. There is a company out there and they already have some kind of balance sheet. They already have some equity. And they also have, so there's an equity amount X, and then there's also the number of shares. Okay, let's call that little x, and then the number of shares. I'll call that n. Now, what you are planning to do is you have an interest to invest in this company, so you're going to bring in some fresh capital. You're going to make a capital injection. So on day one, it actually appears as a cash amount. And then, of course, you are going to be a shareholder. And so the question is, how much should your portion be worth? Okay, and let's call that Y. Okay, and I'm going to call this the new number of shares. I'm going to call it H. So let's say right now there are 2 million shares. Let's just say there are 2 shares, okay? There are 2 million shares. So you are thinking to bring in an additional $1 million to invest in this company. And you are wondering how much you should ask for, okay? And then how many shares should be issued. Now, so this, the next 10 or 20 minutes is really about doing an exercise to evaluate what these numbers should be. And in fact, the spreadsheet that I have knocked out here, VC example, where a lot of these things actually have formulas behind them. They are an interpretation of these slides, okay, that follow. Slide number, what is this one? Oh, so small. 18 and 19 and 20, okay? And I will go through, and 21 as well. And I will go through this example now, okay? Now, before I even do that, I thought it's fun to, okay, I think last week I talked about, there was this program, and I did mention that, didn't I? I mentioned that there is a program called Dragon's Den. Do you remember that? Last time, that's where we left off. And there was this company called Hungry House in the UK. Now, I know nowadays you got, what's that called? Ele.me, right? And Meituan. And in Hong Kong, there's Deliveroo, there's Panda Kitchen, okay? But these guys were really the pioneers. So in the United Kingdom, which may have started the idea in the whole of Europe, these were the actual guys who went pitching in this program, and they got some support. And of course, that's like 10, 12 years ago. Now you look back and you say, yeah, well, what's the big deal? At that time, it was a big deal, okay? So I want to just for fun, I'm going to show you that program. Now, it's not really just for fun because I think it really brings out a lot of ideas that we are likely to confront when we are either trying to start up a business or we are negotiating with someone who has an interest to buy it from us. And it brings up a lot of very, very relevant issues that you are going to see in a moment. Okay, so I want to share that with you. And I found it fascinating as well as quite entertaining, actually. Okay, so let's see if this works or not. Okay, it was actually quite long, but I downloaded it and I actually edited it. Okay, so it's not too long now. Sorry, it's a bit out of focus. This is quite old. Okay, so they are pitching to 5 very wealthy investors, very wealthy individuals, and the rules are so they will be asked questions by these potential investors, and if the investors are not interested, they will just say, "I am out," which means that I don't have an interest to support your idea or give you my money as an investor.
Hello, I'm Tony Charles from House.co.uk. This is my business partner, Shaylin. We're asking for £100,000 in exchange for 11% equity to make.
Okay, so let me write that down. Okay, so £100,000. I think he said 11%. Did I hear him correctly? That's funny. Why not just stay at 10? Yeah, just say 11. Okay. So they want 100,000. You see, that is typically how they start the negotiation. Okay, and this is typically how the investors also they like to think that way. Okay, I am going to commit £100,000 or dollars, and then the negotiation point actually is on this. Okay, and you're going to see that also in the example that I will show you after this video.
I think in the past, But all the venues are right there too. After you click on food you want, we pass the order to the restaurant and they deliver like food. We charge the restaurant a commission on each order. But over the pizza has proven that people can enjoy ordering takeaway through our channels. They now deliver 1 in 7 pizzas this way. Our website spices things up though by adding choice.
A number of European countries have already seen the expansion of
Okay, so by this point, there's one lady and 4 guys. The lady was already out. She wasn't interested. She didn't think this would be she didn't think this idea had potential. Okay, I cut out that bit.
Hungry House attracted 7,000. It placed 15,000 orders. We've grown easily to 150 restaurants, covering a third of London. To fuel expansion and to use our time to market advantage, we need finance for restaurant recruitment, marketing, and product development.
Charles has delivered a professional pitch for £100,000 investment in Hungry House, their online service, which allows customers to order takeaway from a wide variety of restaurants. James Cullen wants to dig deeper into their impressive sounding figures.
Hello, Tony. Hello, Shane. I'm James Cullen. Good presentation. A couple of financial questions. Just a little bit of idea from 15,000 orders you've taken so far. What's the financial model around that? Well, we charge a commission on each order that we send. So what is the commission? What is it generated with the 15,000 orders?
The charge of is 9%.
Okay.
9%.
Orders is 9%.
It's quite expensive.
So this year we've turned over £24,000. But what's your projection going forward? Well, our projection is turnover for year 1 will be £430,000. Expenses of that will be expenses of £400,000. Turnover in year 2 will be £2 million, with expenditure of £1 million, and year 3 turnover will be £3.2 million, with net profit of £2 million.
This driver's response was shaking Tony, but one dragon is not bowled over by their slick presentation skills.
Guys, right, okay, just up it up now. Why wouldn't I do this myself? If I want to go and spend £100,000 of my money or anybody else's money, why do I need you? Well, the value in the business is...
Okay, these guys, these investors, they're not shy. They won't. They're not curtsy, right? Okay. They just guess, why do I need you? That's the question. Okay. So see how they react.
There's a lot of work.
What is the special on your site with a team of, I've got 40 developers full time. How quickly do you think I can replicate that site? Quite quickly.
He's saying, I think I can do it myself. That's what he's saying.
Our focus is on building a community of customers. Well, that's not a unique competitive advantage because that's what I think to employ 2 or 3 good salespeople that go door knocking for me and open up some restaurants and get them their viral. I can do that myself. That's the reason why I'm out. Your competitor that's got 4 times.
You see, when you look back, okay, I mean, this was like 10 years ago. Now they're very successful. So when you look back, there were people who didn't believe in them. Okay, just like in the future, if one day you want to start some crazy business idea, you knock on people's door and say, "What? Whoa! You know, what are you trying to do?" Okay, so don't be afraid of it. Okay, they could well be wrong.
What are they doing?
We can tell you what they're doing in Denmark.
No, I want to know what they're doing here.
Well, our concentrates in Denmark. Let's do Denmark. $300,000 a month.
Okay, what's that convert to revenue in your opinion? What are they generating? Well, very roughly, you could just take 10% of that times by £15 average order, yep, then divide by 10, so that's fairly standard. £1.15, what is it, £300? It's £500,000 a month. Good one, 6 million a year. Far from being alienated by the success of the rival company, James Caan is impressed by the profitability of his business model and is ready to declare where he stands. Let me start the process, gentlemen. I actually do like the concept. I think as a business right now, I think it's quite fledgling. So I think what I would be interested in is, I'd probably go in with £50,000, but I think I'd want 25% of the equity.
It's not a joke, huh? He really means that.
Shane and Tony have secured an offer
£50,000.
of the £100,000 they need.
He wants
But with only
25.
2 other dragons still in, they'll need at least one to share James Caan's faith in the business concept, or they'll leave the den with nothing.
I think you really learn a lot just watching a program like that.
The risks in your business are quite huge. You have got a very strong competitor that's out there doing the business a lot quicker than you, and they're taking some of the market. And there's no barriers to the market. A lot of other people can do it. All you need is cash and some NAVs. And a lot of people out there with NAVs and cash. When I take all those things into account, for me to invest in this business, I'm going to want a hell of a lot of equity. You know what? If we got to that stage, I think you lose your enthusiasm. It could have a negative effect. Yes. Right. Purely for those reasons, I know.
Yeah. He's saying, I'm going to ask for so much equity that I think you just lose your motivation, so I better not even go down that road. That's what he's saying. So this is the only guy left.
I can see this business becoming positive potential, but it is very risky. So for that reason, the only way I can make an offer for the other half of the money that you need is to agree with James on an equity level of 25%.
Right.
You have actually an offer
That's
from
okay.
£100,000 for 50% of the company.
And this guy, Duncan,
Shane and Tony have been thrown a lifeline. The offer of Duncan Valentine and James Caan allows them to walk away with an investment, but at a staggeringly high price. The young entrepreneurs will have to use all their negotiating skills if they're to secure a better deal.
So they got their money, but it's 50% ownership.
With considerably lower than that offer, unfortunately.
Higher.
You wouldn't think about 10%.
Just give me a number again. You said you were going to do what was your forecast? For year one, yeah, 430,000 for 2 years. The two was the 2 million? Yeah, year three is 3.2. 3.2 million. And your profit in year one was 30k? 30. 1 million and 2 million. Yeah.
So he's kind of doing some numbers in his head that we are going to do in a moment, okay?
I feel what I'm prepared to do. If you deliver your business plan, okay, I'm happy to drop from 25% in year one, I'll drop to 20% in year two if you deliver your number. I'm happy to drop to 50% equity if you deliver the year three number.
Do you understand what he's saying? It's almost like an exotic derivative.
so he's going to go in with this amount of money. He wants this ownership. But if you deliver on if your profits are on target, next year I will drop to 20, and the year after I'll drop to 15. I didn't even know you could do that.
But that's what this guy is suggesting. Right? So you actually change your equity level. If they can't deliver on the profit target, the equity level stays. Give you back the incentive.
And we also can see great value in what both of you can offer. So for that reason, we'd like to accept your offers. Excellent then. Well done, Dan. It's been a roller coaster ride for Shane and Tony, but they're leaving the den with the £100,000 they came in for, and with two new and very experienced business partners.
You got the deal. This is how it really started. This is a true story. Okay. Now, I wanted to show you that because it is related to this example that I want to very quickly go through with you. And the example is a simple one, but nevertheless has some similarities. So let's say, so you imagine, these two guys formed a venture called Hungry House, okay? And they already have a business running, and in that business, there are 2 million shares. We don't know how much this company is actually worth right now, okay? And a new investor will bring in $1 million. Okay, so like I said, this is the input, and the investor is thinking to leave at the end of year 5, and they want an annualized return of 50. Wow, that's very high. 50% annualized return, and there is a target income at the end of year 5 that there will be $1 million of income by that time. So these are the earnings. Okay, doesn't say anything about growth. And there's a similar venture that sold some shares to the public recently for $20 million. They sold some shares, and the income was $2 million. Now, I don't mind telling you right up front, the reason they give you this is in order for you to be able to work out the price earning ratio. What is the PE here? So they sold shares for 20 million. So you just assume they sold 100% of equity. Let's just say they did, okay? So it's 20 million P price and 2 million earnings, okay? So the venture income, you can interpret that as earnings. So it's actually 10 times, okay? I'm just letting, because you're saying, well, Sam, this doesn't look like it's a PE. Well, this is not a class in portfolio analysis or equity research, but you can interpret it this way, okay? And it will become apparent to you in the next couple of slides. Now, you just stare at a formula like this, it's kind of probably not making sense. So there are 3 pages of formulas, 1 and 2 and 3. And we can do 2 things. First of all, I'm going to talk about it. And the second thing is I have laid it all out on this spreadsheet anyway. Okay, so the way it works is like this. So the investment, like I said, this is really the driver. It's funny, they negotiate with the end in mind. I'm going to put $1 million on the table. I'm going to put 100,000. I'm going to put 50,000. and the O number of shares. Okay, so these are the items: A, B, C, D, E, F, G, H, I, J, K. Okay, there's no I. So investment, that's A, and so O number of shares. Okay, B, 2 million, and the current PE is 10, and that 10, like I said, just came from here. Yeah. Everyone is okay with that? Yeah. I'm sorry the language is not precise. It's kind of hidden here, but this is really the price over the earnings. Okay, so the PE is 10. Okay, PE is 10. And then, so the expected earnings in 5 years, I better wipe out because otherwise you think this is minus D. No, it's just D, okay? So investment is A. O number of shares is parameter B. Current PE is parameter C. So D is expected earnings in 5 years. The discount rate they're using, very, very steep, 50%. So present value of expected earnings. So I think we're kind of almost assuming this company doesn't make any profit in 5 years. Now you can see from the formula up there, all I'm doing is I'm discounting $1 million by 50% to the power of 5. Wow, it becomes 131,000. Okay, everyone is okay with that? Yeah. Now, if the typical PE of a similar company commands a value of 10, so we apply the same thing here. So we think that this company today should be worth around $1.3 million. I want to say one thing which is very, very important. These numbers, this earnings, this $1 million, the assumption is that this company will earn this kind of money with my capital injection, okay, after I go in. After I go in with my $1 million, this is what's going to happen to this company, okay? So what you're doing, if I was to draw this, so this is the old company. The old company looks like this, all right? Now the new company now has my $1 million. So the new company looks like this, and the value of the new company should be somewhere around $1.3 million. $1.316 today. That's how much it is worth today. And that came from discounting. You're going to start making money in year 5. I think that is the assumption. So from year 5 onwards, it's going to start making $1 million. So you just, again, it's DDM, but you are just discounting. You discount that back to today. And then, so this is the money I'm making. Sorry, if this is how much it's worth, and I am bringing in $1 million, then my share of the company should really be 1 over 1.316. Are you with me? This is how much I think the company is worth, given the discount rate. Okay, so and it's all because I am bringing in my money, so I should own this much, which is roughly around 75%. And that 75% came from here, okay? Dividing G5 by G11. What is G5? G5 is my investment, $1 million, divided by today's valuation. Better take out this minus G here. Okay? Now, as for the number of shares that need to be issued, okay, now this is actually quite easy to work out. I think here the new shares to be issued, so this 75%, okay, there are two things going on here. So first of all, there's the so number of shares, and then the value, and then you just use this formula, the new shares that have to be issued, okay, because now if I bring in this amount of money, I own around 75% of the company. So whatever was here must be approximately 25% of the new company, okay, with my cash injection. And this is actually equal to 2 million shares. Okay, so you actually can work out how many new shares in fact need to be issued. Okay, it's just a simple formula which I have applied here, and the new number of shares you need to issue is around 6.3 million shares. Okay, now so 6.3 million shares would account for $1 million of new investment. So that means the price of each share would be around just a little under 16 cents. Okay. Now, if this doesn't hit you right now, don't worry about this, because A, I'm going to give you this spreadsheet, and two, when you go home, you have the video to look at anyway. Okay. So I think you won't get lost. But is everyone okay here? Sure? Yeah. I want to go through this example with you because it is tied into the last part of lecture 8, and some of you were wondering what's going on. Actually, this page is just a summary of what I have done here. Okay, so all the numbers that you are seeing here, you are seeing here as well. Okay, so I think it's better I just let you go home and review it in your own time. Okay. All right. I do want to touch on this part with you guys. Now, one other thing that I want to go through before we say goodbye. So like I said, you will get this spreadsheet. Yes. Yeah. PE times. Oh, thank you. Yeah. I think it was very late when I was preparing this spreadsheet. Thank you, Nero. I think you deserve $2. No one picked it up. Yeah, it's PE times E. Okay. Thank you for that. I want to, just before we say goodbye, have a look at a couple of articles on tokenization. Now, I do so at the instruction of Xin-Ming. So he wants me to go through this with you, and I'm going to upload these. So I'm gonna provide you the video that you are now of today's session. I'm going to give you that spreadsheet, and I'm going to give you there are two articles here on tokenization. I very strongly recommend you read them. Okay, please. I think he meant this to be part of the teaching, and sometimes he delegates the reading and the discussion of some of these things to me. Okay? I can quickly go through it with you. I think they are very, very interesting. What do you call that? Dao Du, right? Yeah. So I'm just going to give you some guidance on what this is about. Now, the first article is called, you can see it, Asset Tokenization on Blockchain Explained in plain English. The second one is Asset Tokenization, What, Why, and How. Now, I'm sorry the font is a bit funny. When we downloaded it, a lot of the paragraphs started sticking together. I think that the original text wasn't like this. I do apologize. When you write essays and articles, don't write like this. Visually, it just makes the reader very tired when there are really long paragraphs, okay? So a word of apology, but let's just quickly go through this. Let's look at all right, let's look at the first one. Are you all okay with the idea of tokenization? You know what tokens are, right? I actually think that some of these ideas, I call them variations on a theme. You hear that quite often. And, you know, many things in life actually are like that. The theme itself is very simple. And then there are different applications of them. So in finance, mostly markets it's about the distribution of ownership of things that may actually be hard to distribute to start with, okay? If you own a factory and you want to share ownership with some people, how do you even start doing that? It's actually quite hard if you are the sole owner and you want people to share your profit and invest in your enterprise. That's how the concept of equity and stock market and initial public offering. I mean, in the end, if you think about it, that's how it came about, right? Now, that's at the very beginning. And what we're saying is there are other variations such as securitization, okay? Although this is not a class in securitization. There are real estate investment trusts. These are just investment vehicles where you buy a load of properties, which themselves can be quite illiquid. And then you get 100 people to share, you know, the ownership of that. Everyone would chip in $1 million, and then you all share the profit. So that's an idea. You know, people are always thinking of these ideas. Mutual funds or exchange traded funds, all are variations of similar themes. Now, the more recent variations then, ICOs, actually, you know, the platform might be different, but the idea hasn't changed. You got my point. Asset tokenization, again, is when you try to get a bunch of people to share things that could not be shared before, like a painting by Leonardo da Vinci, for example. Okay, just some notes on tokenization. Okay, it is, I think, a way of monetizing the value of something that may be actually illiquid, or maybe it's actually physically not possible to share it. And before, now blockchain would be a great tool to help the record keeping. Okay. To make sure it is solid and immutable means you cannot move it. It cannot be moved. Okay. But there are potential legal problems that they have to sort out. I would recommend that you read the tokenization articles that I just highlighted. Okay, hold on, we're not there yet. Okay. Because I want to show these to you. Now, the first one, so tokenization on blockchain. You have to understand, ladies and gentlemen. Okay, now there are a lot of doubts, I know, regarding cryptocurrencies. Okay, so by now you know what cryptocurrencies are. And you know what tokens are. And they got something in common. They both rely on a blockchain technology. Now, you may have doubts on this one, but I think blockchain and tokens are worth some serious consideration. I think we are now living in a very exciting world, and in 20 years' time, when your kids are running around with their own mobile phones and you are all CEOs and senior managers, you look back and say, wow, did I really do a course on fintech? Now all that stuff seems so basic. And you find yourself, or maybe even your sons and daughters, trading bits of paintings by Monet or Da Vinci, or trading, expensive or exotic vintage cars or red wine in France and stuff like that. Okay, and I think that day will come, and the excitement people have now is kind of like the excitement 10, 20 years ago when all the other types of financial innovations started happening, things like ETFs. Okay, because in the end, I think a token has some similarities with ETFs. And I'll come to that in a moment. Okay. Now, tokenization, it seems that everything is being tokenized on blockchains, from paintings, diamonds, and company stocks. Anything that moves and has value, especially value that goes up, can be tokenized. Okay. So they're going to, in this article, they want to discuss what it means to tokenize an asset on blockchain and how it can apply to physical assets. Now, so this guy started by talking, if you only have $5,000, which is what happens to, a lot of people, but you want to make some investment. So previously it wasn't possible, just forget it. Just put it in a bank and just go home, right? But now maybe you can. And with traditional real estate, this was not really possible. How can you buy 2 or 3 square meters in an apartment? Okay, $5,000. You can't even buy 1 square foot in Hong Kong. Okay, you can't even buy space to stand on. Okay, that's how sad it is. That's how expensive it is. So let us reverse the situation. Imagine you actually have a property yourself, and it's valued at 150,000. I suppose they mean US dollars. But for now, for some reason, you need $10,000 in a hurry. Can you do this quickly without any friction or trading costs? To my best knowledge, you can't do that. That is when tokenization might be able to help. So you can try to tokenize your apartment, and they just say, suppose this is a I don't know why they changed the value. So $200,000 apartment. So you tokenize it and issue 200,000 tokens, and then you start selling these tokens to people. Thus, we took an asset, tokenized it, and created its digital representation that lives on blockchain. Now, blockchain is going to be a key part of this, okay? And I think it is because of blockchain that now suddenly everything seems so exciting, okay? Does it sound too simple? Unfortunately, some problems need to be solved, and the main problem is nobody right now actually has any regulation on cryptocurrencies or tokens, okay? And if you buy the tokens, you actually don't have legal rights on the property, and so you're not protected by law. But I think this is a problem that can be overcome, and I will explain to you why in a moment. Another problem is that the system brings us back to some sort of centralization. So the whole idea of blockchain is to create a trustless, and trustless is not really a good word. I think they mean an environment that does not require any trust, because everything is all locked up and cannot be changed, okay? While this is possible to tokenize digital assets, in the real world of physical assets, like we have to accept some sort of centralization. For example, I think what this author means is if you were to tokenize a painting, a very expensive painting by Picasso or Van Gogh, okay? That painting itself has to be stored somewhere, okay? So you got to know where it is. So it cannot be completely decentralized. There has to be some kind of organization. Somebody has to look after the asset, okay? They're talking about Picasso just now. Now I'll tell you why this legal issue may not be as complicated as you think, because you look at it carefully, all right? So if you set up an ETF, you ask yourself, what is actually going on in an ETF now? If you set up an ETF, then what's happened is investors will give you money, and you are going to issue fund units, or they're actually called shares, okay? So you issue shares, and then on the other side, you're going to buy assets. Now, these assets can be anything. So they can be bonds, they can be shares. There are all kinds of ETFs out there on all kinds of stuff. In fact, you can think of putting very exotic stuff here, okay? And then you are issuing shares, and investors are buying the shares. Now, that is the essence of an ETF. And you can see that, it's really not that complicated. Now, so what actually can you do with these shares? Legally speaking, so if you are in a fund and you are a shareholder, with these shares, you actually have claims on the assets as a shareholder. Now, so the problem is, now you got something like, so on this side, it might be a bit different, okay? A Picasso painting. It's still just an asset, just like any other. And then on this side, you don't have shares, you have tokens. Now, it's going to take some time. There is a legal framework governing how these shares can actually claim on these assets. Right now, that legal framework does not exist between these two, but I think it can. I think it can, because the idea is already there, and the idea has been there for 300 years already. What idea? The idea that you have an ownership of something which is proven and documented and regulated, and that claim can be used to claim things that you buy on the left hand side. Right now, we don't have a framework like this for tokens, but I think that day will come. You know what I'm saying? From a balance sheet point of view, the two actually are not that different. So tokens are issued, tokens are a liability. The assets that you want to share, they are on the left-hand side. Okay, paintings, wines, expensive cars, whatever. Okay. Now have a look at this one, and then I'll let you go. Okay. Crypto token is a secure digital record. That record could contain rights to any assets. That record can be viewed as a container, a wrapper. Okay. Rapper, not as in rap music. Okay, not that. That one is without a W. Okay. This is rapper with a W. It's funny, yeah? All right. So traditionally, when investors buy assets, they do that in different containers or with different wrappers. A company's shares are wrappers, containers, paper, securities, giving investors percentage of ownership in a business. Okay. If you want to buy gold or silver, you might do so with an ETF or futures contract. These are just different avenues. Okay. Now, how do investors actually choose the so-called container or the wrapper? Okay. The platform, in other words, is based on, what they understand about the platform, the technology. Okay. Do they like trading futures? Do they like trading stocks? Crypto wrappers or crypto containers are quite unique and is a new choice for investors. Okay. It doesn't mean everybody will choose it, but some people probably will. And the how many people will choose that will depend on the asset, and the value of the crypto platform also, it varies from one asset to the next. Okay. And if you want to buy Amazon or Google shares, putting that into wrappers doesn't make any sense, because you already can buy those shares, at least in the United States and developed countries. Okay. At least until the so-called crypto securities trading platforms get to a point when it becomes cheaper to trade securities that way. I think this can happen one day. There is actually a market. I don't know if you've ever heard of it. Do you know what CFD stands for? Have you ever heard of that? CFD stands for contract for difference. This is exactly what they do. For example, if you are in, or they mention Russia, okay? If you are in some faraway places and you are not able to trade some securities or some stocks, or maybe you want leverage, you trade some kind of private derivative contract, and it's called contract for difference. Okay, so first that idea wasn't very popular, but then it got cheaper and cheaper, so more people actually were thinking about it seriously. So I think crypto assets can go this way, and crypto tokens have new attributes that can be appealing. Okay, tokens are fractionable, so you can divide them. If you want to buy $100 worth of Amazon stocks, you can't do it because Amazon stocks are like $1,600 per stock for one stock. And tokens are mobile. You can have them on your phone. Well, you can do a lot of things on your phone. And here is an interesting paragraph, okay? So asset tokenization is a natural extension of investable funds, okay? This is an interesting way to think about this. So the market evolved from very old-fashioned, closed-end, classical, traditional dinosaur funds to mutual funds to ETFs, each step reducing cost and friction. Now, going from ETF to CTF, what the hell are CTF? Crypto traded funds, okay? This guy even has a term for that, okay? Is a natural evolution in that direction, okay? So this guy is predicting that this will happen one day. I think the key to it is that you need to get the legal framework and the tech framework and the cybersecurity all in place, and then this can really take off. Okay, so he's calling it CTF. Okay, and then the thing about fintech and digitizing assets and tokens is the key thing about that is, which is an advantage and also a risk, is that they cross all the borders. So you can have an analyst looking to set up a basket which might have some stocks from Brazil and Russia and India and China and so on. Sorry. Okay, we're finishing soon. So you can have a basket of tokens. This is what this guy is imagining, okay? So you can have a basket of tokens, and there is really no limit to it, okay? So because there's nothing regulating it, at least not for now anyway, okay? So this article is quite interesting, and I think you should read, as widely as you. Don't hesitate to read around. You don't have to just read these pieces, but I don't think Xin Ming would just ask you, what is tokenization? Come on, we're MSc, okay? He would go beyond that. I'll tell you now. I'll tell you that now, okay? He would love you to have a discussion the way I'm discussing with you here, okay? Which requires not hardcore memory, okay, but just an overall understanding of the trends and the pros and the cons, the strengths and the weaknesses, okay, the attraction and the drawbacks and so on. So think of it that way, okay? Is everyone okay? I think I've given you enough clues, okay? The biggest clue I've given you is this one. Okay? You got me? Everyone happy? All right, then, yeah, sure.
So when I see the process of
Yeah.
Can show the assets back to the securities.
Yes. Yeah. It is. The reason it is. The reason I didn't mention that now it's good that you point this out now. So think about what's going on. So I mentioned ETFs. Now ETFs are a bit different. ETFs, so you buy exchange traded funds. So you buy the shares. So they trade like shares. I told you last time there was this ETF called AIEQ, right? The robotic, the AI fund. So you buy the shares, and with these shares, you can claim on the assets, whatever is in there. Now that's ETF. mortgage-backed securities or asset-backed securities. Actually, the concept is similar. The reason I didn't mention this, Harris, is that these have more of a fixed income flavor to it. So when you buy asset-backed securities, so quite often these are loans and mortgages or credit card debt. But whatever you are doing, it never gets away from the idea of issuing something so that investors can claim on the assets. But these are more like fixed income assets, whereas ETFs, these are more like equity type assets. And the reason I think tokenization is closer to ETF is when you got a bunch of Picasso paintings, they're not really fixed income, okay? Or like vintage cars, or very, very exotic stamps, or French wine, or whatever. They are closer to exotic assets. And then you got tokens on the other side, okay? You got tokens. So here you are issuing asset-backed securities. Yes, I think there are similarities and there are differences as well, okay? Are you with me? But they are, like I said, I go back to what I said 10 minutes ago. They are all variations, ladies and gentlemen, on the same theme. The theme always is you purchase something on the left-hand side, right-hand side, with a claim on the left-hand side. So that almost never changes. You with me? Yeah. Good point. If you don't have any questions, then I'm going to produce this video and I will put it online for you guys, and tell all your friends, all the other people who can't come tonight, okay? There's not going to be a tutorial next Tuesday, and they know that, okay? But if they want to view this, it should be available very, very soon, okay? And it will contain that calculation, which I enjoy knocking this out. And first I looked at these slides, not these. And I was trying to figure out, okay, what is going on here? And finally I figured out what's going on, okay? And I hope you can too. And they are here. All right. I won't take attendance tonight. So I guess we'll see you next Tuesday at 6:30. Okay? Thank you, everyone, and have a nice evening.